Hi everyone, welcome to our DAT IQ weekly market update. This is our update for June the 10th, episode 295. I'm Dean Croak, market analyst here at DAT Freight and Analytics. I'm sitting in today for Ken Adamo, who's on vacation, and I'm joined with our special guest today, David Hoffman from Puratus. David, welcome to the show. Great to have you on finally.
Hey Dean, thanks for having me on. I'm a big fan.
Yeah. Whereabouts are you located?
So I'm right here in Morristown, New Jersey. So just think of 25 minutes east of Philadelphia.
Yeah. I was in York, PA last week at the American Truck Historical Society. I think I saw an exit to your town on the way back.
That might have been Morristown because people will get that confused. That's in North Jersey, but yeah, I know what you're talking about.
Yeah. Traffic's quite the deal around that area, the Tri-States area.
It's very congested here. That's a good way to put it.
Yeah. David, tell us a bit about what you do and what people can expect to learn from you on the show today.
Yeah. So first part of my career, I spent 12 years as a landscape contractor and then finished college a little bit later in life and entered the world of supply chain. When I entered supply chain, I started at C.H. Robinson. When they hired me, I started as a freight broker, pretty much did the whole lane pricing, negotiate rates with carriers. And then they moved me over to the account management side. And a lot of my responsibilities were, the simple stuff like account growth, KPI development, leading and overseeing transportation outsources. And one of the terms you've heard a lot is just trying to help customers become, I call, shipper of choice. After being there about 5.5 years, I went to a small freight forwarder, BDP International, for 9 months, did the similar thing. And then 5.5 years ago, I came to the shipper side at Puratus, where I am now. So same thing, just helping them with their transportation initiatives, KPI developments, and just kind of trying to understand what their goals were, making them become a shipper of choice. And I will say it's been very interesting because you get to just see all the facets of supply chain on the shipper side, whereas when I was on the transportation side, really I get to see just the transportation piece, if you will.
Yeah, that's a unique experience. I'm really looking forward to talking to you a bit about it at the back end of the show. All right, so we'll bring David back after we get through the market update. Let's get into that now. For those of you new to the show, we're here every week at 10 a.m. Eastern, 7 a.m. Pacific, talking about the freight market. If you've got questions, drop them into the chat section, and we'll get to them towards the end of the show. So let's start off with the market update with some of the key trends. Spot rates pretty much flat across the board, slightly up in flatbed, but that's kind of good news for a lot of carriers out there as diesel drops. And on the broking side, we're starting to see the market bottom out, although we've been saying that for quite a few months. A couple of the leading indicators we're watching, especially for flatbed carriers, is the ISM PMI. Contracted for the second straight month. That kind of extinguishes hope that March's expansion was the start of a growth cycle. Per the ISM, if this bump in the roadway on the way to recovery, if this is a bump, things won't smooth out until demand picks up and companies have more clarity around monetary policy by the Fed. Zach's Logistics Managers Index, Zach Rogers, comes in at about 55.6. It's up 2.7 points from April's reading. The LMI has expanded for 9 of the last 10 months in the last 6 months in a row. And a bit of a surprise, Class 8 preliminary truck orders, we won't know until the 15th until we get the final numbers from ACT Research. Steve Tam said that the numbers sort of zigged when the market expected they'd zag. It was a really interesting way to put it. With ample slots in Q3 and Q4 opening up, everybody was really surprised at some of the numbers that came in. Net orders were up 46% month over month and 49% year over year. Steve puts that down to the strength in private and vocational fleet growth, supplemented by an ongoing healthy appetite for equipment in Mexico. So let's dive into our market update. Let's start with our load to truck ratio in dry van. Load post volumes were down 3% compared to this time last year. Again, tracking pretty close to where the market would be for the first shipping week of June. However, there were less carrier equipment posts last week. Load to truck ratio at 4.38 in dry van. In the reefer market, produce season starting to ship meaningful volumes in the lead up to Independence Day. Load post volumes up 3% last week. Still about 9% lower than where they were this time last year. Load to truck ratio down slightly to 6.06 loads per truck. And in flatbed, following seasonal trends for the first week of June, Volume surged by 15%, albeit on the lower end of the week 23 increase going back 8 years. So normally the first week of June, we see flatbed volumes surge and they start to slow down fairly significantly from here on into September. They're about 8% lower than last year in terms of volumes. Equipment posts are about 24% lower. Flatbed load to truck ratio down slightly to 17.94. A couple of the markets we're looking at, capacity tightened across most of the major markets last week. The volume of loads moved nationally was up fairly well last week, up 31% week over week, consistent with that surge in volume we talk about in the first week of the month. In the top 5 states, California, Texas, Georgia, Illinois, and New Jersey, and the spot market rates up 3 cents a mile on a 27% higher volume. In Los Angeles, impacted by 9% higher import volume than last year, the volume of loads moving increased 22% week over week. Outbound line haul rates up 4 cents a mile to $2.19. And in the adjacent Ontario market, line haul rates averaged $2.28. Remember, folks, these are line haul rates excluding fuel. So line haul rates outbound Ontario up to 2.28 on a 14% higher volume of loads moved. Having a look in the southeast, Atlanta's volume increased 26% week over week, driving up line haul rates for outbound loads by 4 cents a mile to just over $2.01. Chicago outbound volumes up also, spot rates up 5 cents a mile to $1.96. In refrigerated, this time last year, the USDA reported a shortage of trucks in Nogales for loads of Mexican produce. And in Florida, as watermelon season rolled on, this year, though, all 17 growing regions report an adequate supply of refrigerated equipment as national produce volumes lagged last year by about 4%. Now, unlike last year when Mexican imports in southern Texas reported a slight surplus of capacity, last week capacity loosened even further. The USDA reported a net surplus of trucks in the market. The Mexico produce season is starting to look like the peak arrived a little bit earlier this year. Volumes are about 6% lower than last year. Most of that volume comes across in far Texas. That's in our McAllen market. Volumes in that market were up last week slightly, but line haul rates were down 15% week over week to $2.43. California produced about 36% of USDA produce volumes last week. That's trailing last year by about 9% when the state accounted for close to half of the loads as we got to the end of May. So volumes are a little bit lower in one of our biggest states. That's a trend we're watching very closely. And Florida accounted for 22% of last week's truckload volume. That compared to 14% this time last year. Florida's having a really good season this year. All right, moving on to flatbed, having a look at the West Texas Permian Basin market. Baker Hughes reported energy firms cut the number of oil and gas rigs last week to the lowest level since January 22. The oil and gas rig count is an early indicator of flatbed demand. It's about 15% lower this time last year. A large market for drill pipe casing and oil field is Houston. It's a massive spot market for flatbed carriers. A lot of that volume moves out to West Texas and the Permian Basin, where about half of the rigs are located. There's about a 17% lower volume of loads moved on the Houston to Lubbock lane. Flatbed line haul rates on that lane are 37 cents a mile lower, averaging $2.45. Up in Indiana, carriers reported some pretty good gains last week. There was a surge in volume, pushing up outbound rates by 8 cents a mile to $2.54. A lot of the gains are in neighboring South Bend next to some of those big steel markets. Rates jumped 14 cents a mile to $2.53. A lot of the volume moved regionally to Minneapolis. Those loads were up 10 cents a mile to $2.58. So wrapping up our market update with our year-over-year look at spot rates, the dry van line haul rate was mostly flat last week as carriers returned to the market in full force. At $1.66 a mile, line haul rates are 2 cents a mile lower compared to last year on a 9% higher volume of loads moved in week 23. On our top 50 lanes, based on the volume of loads moved, they averaged 201 last week. That's 35 cents a mile higher than the national average. And in refrigerated, the national average line haul rate ended last week at just over $1.97, up by just under a penny per mile. At this level, reefer line haul rates are about 12 cents a mile lower than last year on a 7% higher volume of loads moved. And lastly, in flatbed, after remaining flat last month, flatbed line haul rates increased by about a penny per mile last week, averaging 208. The national average is 10 cents a mile lower than last year on a 15% higher volume of loads moved for week 23. All right, so let's go through our short-term forecast. Not a lot of change this week compared to last week. We're still seeing much the same trend through July 4 out to 7/13 this week. For those new, these are our short-term forecasts. They're about 35 days. In terms of the colors on the chart, the blue line is the rolling 7-day weighted moving average of historical rates. These are loads moved over 550 miles excluding fuel, so they're line haul only. Green is our flagship model, Ratecast. Red is the short term. Importantly, red weights more heavily data that's seen in recent weeks, whereas the green is more seasonal. And then you've got the yellow and grey, which are blends of the two. So starting off with dry van, pretty much the same as last week, a fair bit of consensus directionally. Although this year's peak in produce is starting to have a little bit more of a speed bump effect than a true peak. Ratecast is reflecting some of the seasonal trends that we typically see. It's looking for about a 5 cent per mile lift from where we are today through 7/13, including the July 4 bump. Whereas Ratecast is looking for an 11 cent per mile lift. So again, much the same numbers as last week. I expect that Ratecast will be right on the money, given the excess capacity that's in the market and some of the softer demand that we're seeing. As we covered earlier, produce season is really not delivering the kind of volume we're used to at the end of May. Volumes are down about 3%. The short-term model is being overly optimistic again, I think, at a 12 cent per mile lift this week. Ratecast is about 4 cent per mile over the next 35 days. Again, I think just like dry van, that's much closer to the money. And then to end with flatbed, much more model agreement. Ratecast is expecting rates to cool heading into next month. Again, not much change from last week. The short-term model is expecting a 4 cent per mile drop in the next month, whereas Ratecast is about half of that at 2 cents per mile. So again, I think Ratecast in all of our three models is very close to where we see the market moving, impacted both by excess capacity and some of the softer demand that we've been talking about, which sort of brings us to our question of the week and our guest. Let's bring David back in and talk about some of the demand in the food industry. David, food accounts for about 25% of truckload ton miles, according to Jason Miller at MSU. What can you tell us about demand in the food industry in general?
Yeah, so a lot of the, I guess, data sources I've looked at, right, going on St. Louis Fed. You had mentioned earlier about produce volume. So I was on, I guess, the Department of Agriculture last week. I'm seeing the similar things. I think produce volumes last I checked was down around 6%. It'll be interesting to see how things play out before 4th of July, if we'll recover, if it'll kind of still be flat. But when you isolate, food and beverage, particularly on the Fed's websites, you're just seeing the same thing. And I think a lot of that's also being echoed in the market when you listen to these publicly traded trucking companies, their calls on Wall Street, they're seeing this, the brokerages are seeing this. So, I guess to kind of steal a slogan, if you recall back in the 90s, Dean, Kawasaki had a slogan where they said, let the good times roll. So if you're a shipper right now, you got the hot potato, you've got that. Like when the pandemic hit, for example, and they were starting to come out, the carriers were able to have that slogan. So I think everyone's just kind of waiting to see what sort of event is going to turn the market. Is it going to be a hurricane? Right. Is it going to be more capacity exiting the market? I mean, no one really knows, but to your point, I'm seeing the same thing.
So your company, Puratus, is in the food business or bakery more specifically. Is that correct?
So specifically, we manufacture food ingredients. So a lot of things that would go into food to help with shelf life, to enhance taste, those types of things.
Right. And from a truckload perspective, are you mostly a contract carrier or a spot market carrier?
So we do contract. Right. We run that, on an annual basis. Mm-hmm. And what I try and do, or what I like to do, is I like to form relationship with my carriers. I don't try and play in the spot much because, again, I've seen and I've talked to other shippers that have done that, and it just usually comes back to bite them, if you will. Yep. So yes, we do mostly as many lanes as we can. It has consistent volume. We contract.
Yeah. We look at on our side. We look at our contract rates every couple of weeks. Active rates in all of our routing guides are pretty much flat. But the more alarming number, I think, is that new rates based on RFPs across the board are still decreasing, albeit at single-digit rates, and that's got to be I think, a concern for shippers, right? Because we've had double-digit rate decreases most of last year, but at some point you have to realize the market is going to tighten. How do you look at that next market cycle? Like, are you thinking that capacity is going to be tightening and there'll be fewer trucks around?
It's so hard to say because I feel like as long as I've been doing this, Dean, right, it kind of just, it goes so quick. Like back in 2014, you had the polar vortex. In 2017, you had the hurricanes come through the South. 2020, the pandemic. So, I think the best we can do to prepare as a shipper, and I mentioned the term earlier in the show, is just become a shipper of choice. Try and work with your carriers. Try and make sure you have, certain amenities that they want. Try and give lead time. That's one area that I really like to focus on. I think if you can give your carrier base proper lead time, and when I say proper lead time, I'm talking like 72 hours. Yep. I think that gives you the ability to ensure you can get the best rate possibly. At the same time, most carriers know that, hey, if you're putting a load up on the board at, let's say, 2:00 in the afternoon, you're not going to pay the best rate.
Right.
So just try to develop those relationships with your brokers and your carriers. Try to give proper lead time. Communicate when you're having challenges. Like, I would say a couple of weeks ago, we just had DOT road check. I know while shippers have enjoyed low rates, during that week, a lot of shippers were struggling for capacity because everyone parks their trucks for that week. So while you're seeing these rates, there are blips, there are instances where you're going to see tightness in the market depending where you're shipping out of, and you just have to be ready for that and communicate.
Right. What sort of trends are you looking at that might completely upset? You mentioned hurricane season, but are there any other catalysts in the market that you're looking for from a consumer demand? Is it credit card delinquency rates? Is there something out there that you think might be another factor?
I think it's the elephant in the room, right? I think it's the Fed. Right. What are they going to do with interest rates? Right. Is that going to kind of spurn more spending? Are companies going to start to invest? I mean, it's, you just looked at the ISM index last week. I feel like we've kind of been ping-ponging in between that 50 number. So we're still kind of flat. And I think it's just a combination of things, Dean. But, there have been times, like I said earlier, where it's just that one event could be a natural disaster that just, it takes off. So if my crystal ball would work, I would, it would be a different answer, but it's so hard to really say what's going to have that ultimately uptick in demand that, we start to see rates go up.
Yeah. It's interesting. One of the trends that we see is, of course, is capacities hanging in the market much longer, largely because of that incredibly profitable period we saw in 2021. I think many market analysts underestimated just how much cash carriers were able to sock away during that period, because most of the fleet count growth were in the smaller fleets, sort of less than 10 trucks, but most of it was in that 1 to 4 range. And those carriers, by and large, did really well. So I think it's kind of a bizarre situation we're in, where we've got really high truck orders, new truck orders. We've got fairly high numbers of trucks being pre-purchased ahead of the 2027 emission regulation. That's having a flow-on effect into the used truck markets, where you're seeing the market flooded with capacity on the used truck side. And of course, those prices are coming down, which adds more capacity into the market. So we're seeing kind of a really bizarre situation where demand is soft, but capacity is kind of sitting there, not really changing fundamentally. And that's something that we've seen change this market cycle, which sort of leads me to this question. What's changed as a result of the pandemic in your world? What's changed forever? Because we talk about a lot of their basic market fundamentals that we look at from seasonality have kind of disappeared, and we're into this really strange environment that's still being impacted by the last 4 years.
I think the biggest thing that I have seen changes, right? I think supply chain finally came on the map, right? I mean, they talked about it every night on the news. You heard the term just around driving around, talking to other people, understanding what it's all about. I think the importance of just people in the transportation sector, not to diminish any of their supply chain professionals, but I really think it peeled back the curtain to show how vulnerable supply chains were. Particularly, these ocean carriers, right? There's only so many of them. And you kind of saw it basically was, pay to play, for lack of a better term. Like if you want to get cargo space, and you saw certain companies like Costco, Home Depot, they were chartering their own ships because they needed to get the products into the stores. So I think first and foremost, it brought supply chain to light. I think it also kind of made companies think about what sort of supply chain strategy do I want? And what I mean by that is, am I going to be a just-in-time player, or am I going to be a just-in-case player? I kind of I tend to lean to the side as just in case, as an Eagle Scout, be prepared, right? So I think that's something that still companies are struggling with, because again, then you work, okay, how much inventory do I want to carry? How much working capital is that going to eat into? So those are some of the things I think you have companies that are still kind of really evaluating these days. And ultimately, that could change again. If they all of a sudden have a demand, they're going to do just in case. If it stays flat like this, they might just go back to the just in time. So it really depends.
Yeah, we've seen a couple of things change the market, in terms of unusual events. Road Check Week wasn't unusual; everybody expected that. But whenever you have anything to do with controlled substances, authorities are in and out of a driver's cab. They see that as a real invasion of privacy, and you're kind of guilty until proven innocent in most of those cases. So you tend to see whenever there's hours of service or anything to do with controlled substances, you see a much higher rate of drivers taking time off. And I think that just showed us how little of an impact a relatively small event can have on spot rates, because it's not a really big deal when you think about the total numbers, but it moves the capacity needle substantially in that area. The other one was in mid-January. We had a bit of a cold event. We had a polar vortex type event, and rates went up and then came back down. So I think the point is that we're primed for market disruption, because those two events showed us that it doesn't take much to move rates upward. As we sort of head into what would normally be a peak season, but it's certainly looking fairly flat this year. One of the other trends, and I'd be interested in your take on this in terms of warehouse location. We had Ibrahim Bayan on our show last week talking about warehouse capacity, and warehouse vacancy rates are trending back towards the 6% national average, but much higher, double in some cases in some markets where they're very much oversupplied. One of the trends that we've been tracking is warehouses moving capacity or warehouse capacity closer to populations. Is that something you've seen or you're taking into account, or you're trying to reconfigure your distribution network to accommodate?
So I don't want to say that necessarily falls under my umbrella, but to your point, I have seen a lot of, industry-related articles where you see Amazon, for example, perfect example, where they are starting to put warehouses a lot closer to their customers.
Right.
So I think what you're looking at is a lot of companies now, they want to try and reduce transit time. They want to try and be quicker. They want to try, we've kind of become the society where we want everything instantaneously. I'm old enough to remember where you had to actually go to a store and get it. You didn't order it online. So they want to be able to have that same day or 2-day availability. And I think that a lot of companies that are really trying to do that, not only from a customer standpoint, but I think they want to also have production facilities closer to their suppliers.
Right.
So they can get raw materials in quicker, so they can keep production lines running. But I did hear the same thing from you. Vacancy rates are going up. There is warehouse space that's available, but I think again that's cyclical, right? It's going to come back. There's going to be demand, and then they're going to fill all those warehouses up again.
Yeah. It's kind of amazing that for those that have been around a few market cycles, I was always perplexed at how many warehouses are being built, how many 53-foot intermodal containers were being purchased, and how many people were buying 53-foot box vans. It rang out to me that we're just going to have an excess capacity at some point when the market settled down. I think what a lot of us didn't really appreciate was how high up the market went and then how far back down it really came. One of the other trends, interested to see if your companies, if you've got anything you can share about, we're seeing companies, consumers spending less this year, and certainly not just spending less in total dollars, but changing their mix of spend, like more store brands as opposed to name brands. Is there anything you can share from a consumer's perspective in the food sector?
Yeah, so I think to your point, right, companies have gotten a lot more strategic in studying their customers' buying habits.
Right.
What's necessary versus what's, a want, if you will. So maybe when they go to the grocery store, instead of buying maybe those Oreo cookies, right, they're going to buy maybe a box of oatmeal because they need breakfast is more important than dessert, if that kind of makes sense. So that's one of the things that I've kind of, looked at. There's been a few reports out. I would even say take it as farther as dining out, Dean, right? Mm-hmm. Where it's now people are calling it a luxury. I think you see people pulling back on that, where they're focusing more on their at-home food. I know Walmart's gaining a lot of share of middle to high-income earners are doing grocery shopping there. Right. So those are just some of the trends that I've seen as far as overall consumer spending when it comes to what they're buying for food.
Right. And on top of that, from a truckload demand perspective, volumes are down year over year, but we're also seeing more shippers move more freight on their own dedicated fleets, which is counterintuitive in a soft freight market like we're in from a rate perspective. Any thoughts on that?
So I was going to bring that up. So when we talked about the capacity exiting the market, I've read commentary that they've said a lot of capacity that has exited, or a portion, if you will. Some of those companies now have invested that and not using third-party carriers anymore, but they're investing in their own fleets. So they want to have control of the freight,
right.
Drivers, when they can deliver, how they can deliver, because some customers, for example, they might have specific delivery requirements. So, what portion of the capacity that's leaving is going out of fleet and companies? I think that, every company is very customer centric. So I think when the pandemic hit and they were having trouble trying to find trucks, or they were paying a lot more for trucks, hey, how can we reduce some of our costs? Do we maybe want to put more product on fleets?
Right. I think for a long period of time there, we reported, I think, 6 quarters of double-digit rate increases from the middle of 2020. And then we had like 6 quarters of double-digit rate decreases. Yeah. And I think the net of that was a large shipper would have looked at that and said, over the long arc of time, we could probably have a bigger private fleet and be far better off when we have a 5-year time frame perspective. And I think that's part of it. But as we talked about last week on the show, private fleets have an 8 to 9 year duty cycle on their trucks, and that spans 2027. There's already, at the truck show last week, where I was at the American Truck Historical Society show, there was a lot more carriers this time around talking about getting their orders in right now so they can get a 2025 truck. I think it's a pretty big deal, and that's going to help exacerbate this problem we've got, where a lot more private fleet work and dedicated work will be sort of staying within a shipper's realm as opposed to more truckload demand.
I think to your point, right, there was an article that came out, I forget who published it, but Ryder just did a study, because again, they're talking about the whole, push for electric trucks. And some of the statistics they had in that report was interesting, just the amount of cost,
right.
Because the batteries are heavier, they'd go through tires faster. They'd have to, the hours of service be affected because the amount of time it takes to charge, or how many times they would have to charge a truck to get to their destination, particularly long haul. Truck drivers definitely have some challenges ahead of them. And then even now with all the states that are suing California for, I think it's the AB5 or the CARB rule, which I forget which one it is, but there's definitely, it'll be interesting to see, because if that goes through, how's that going to affect carriers going to California? Yeah. I know a lot of the railroads were concerned about having to swap out diesel engines, because how would that affect them? So there's definitely, there's a lot of challenges they're going to have to figure out on how to, come through this and be able to ensure we still have capacity to meet the demand.
Yeah, there's lots of things happening that are sort of, that word unprecedented comes up again, but Ryder's interesting analysis showed that the cost to convert a truck to EV is almost double. Yeah. That was a really interesting report. So, and there's some regulatory creep going on, both around, alternative energy sources for trucks. There's the speed limiter debate. There's some things happening that could change that capacity, not just in California, but nationally. Yeah. David, I'm curious as to, I was at a conference about 8 years ago, and we were talking to shippers, and shippers sort of, from a carrier perspective, shippers always seem to be the last to know about what's happening in the market, just generally speaking. But today, I think it's very different. I think shippers today are more informed than ever before. Is there any particular data set that you're aware of, or what's changed in your world, say, compared to maybe 10 years ago from a understanding the freight market perspective?
So I would say, I think it also depends who is in the shipper's department as it relates to logistics.
Right.
I would kind of call myself a freight nerd, right? Once I got into it, I felt it made sense to me. I really liked it. But some of the things I'll go to, Dean, and again, I'll give you guys a plug. I do watch your show every week. I will wait to see when the CAS index comes out. I like Tim Denoyer's report. I'm on the Fed like you are, Department of Agriculture. Those are pretty much the main ones that I'll go on, and I'll look. The ISM index, I like to look at that. And just, I've also found too, a great area, one of the sources I will use is I'll sit on Wall Street calls with publicly traded trucking companies, and I'll listen to what they're talking about. And a lot of the charts that they use, I find are helpful. If I can't be on the call, I'll just read the PDF. But I think as a shipper, what I found, at least in my role, was to be able to have the knowledge and go to your executive team and tell them what's going on and what they need to do. So I've kind of gone with the philosophy of, I can explain the why, and then here's what I think we should do, and I give options.
Right.
And I think anyone who sits in that chair, if you can do that for your organization, I think you'll be an asset. But also, 10 years ago, I mean, the internet was here, but I think you just there's so much data at our fingertips now, and social media, that it's almost impossible not to know, even if you don't want to know, right? So, but I do think it's our job as shippers and logistics, particularly, that we have to kind of educate our organizations constantly.
Yeah.
And just say, hey, here are the trends, and here's what we expect to come down the pike.
Yeah, it's like a massive jigsaw puzzle, right? No one data piece is sort of tells you the whole picture, but if you put enough of it together, you get a picture. I think the key is a consistency, though. You've got to consistently look at those data points to start to see what the trends are.
Yeah.
David, that sort of brings us to the end of our show. I've got a couple of plugs, and then we'll come back to you. This has been a fantastic conversation. Next week's show, we've got John McCown, international shipping expert. May import numbers are out tomorrow. He'll be able to give us some perspective on what the May numbers look like comparing to last year. I'm on Jimmy Mack's radio show on Sirius XM on Thursday, 8 a.m, Sirius 146. I'm also here at the TSMA 100-year anniversary conference in New Orleans today and tomorrow. That's going to be a fantastic event. Make sure you call by and see us if you're there. David, if people have got questions or they want to contact you, what's the best way for them to get to you?
Yeah, best way is LinkedIn. My contact information is on there. Always happy to talk with anyone in transportation.
Yeah, thank you. All right. Well, that brings us to the end of another show. Be safe, everyone, and we'll talk to you again next week at 10 a.m. Eastern, 7 a.m. Pacific.